All right, let's jump right in. Every investor at some point faces this exact same question. Do you try to find that one needle in the haystack, that next breakout stock, or do you just buy the whole haystack? It's the classic showdown, and today we're going to settle it. By the end of this, you'll know exactly how to think about it. So let's make this super practical. You got $1,000 ready to go. Do you put it all on that one company you've been hearing about, the one you really believe in? Or do you, in a single click, spread that same $1,000 across hundreds, maybe thousands of companies? What's the right call? That's the puzzle we're going to solve together. This isn't just about where you put your money. It's really about choosing a philosophy for how you want to build your wealth. You're either making a very specific bet on a single player, or you're betting on the entire game itself. Let's break down what that really looks like. And here it is, laid out as simply as possible. On one side, you buy a stock, and you own a direct slice of one single company. Simple enough. On the other side, you buy an ETF, and you instantly own a tiny piece of a huge basket of companies. This is the absolute core of it all, concentrated ownership versus diversified ownership. With an individual stock, the key word is control. You have total command. You are the pilot. You decide exactly when to get in, and you decide exactly when to get out. But, and this is the big but, it also means all of your hopes for growth and all of your risk are riding on the success or failure of that one single business. Now flip that coin over. With an ETF, you're not buying control. You're buying systemic strength. You own a share of the fund, which in turn owns all the companies. This is a game changer because your success is no longer tied to one company's brilliant or terrible decisions. Instead, you're betting on the overall health of an entire market or an entire industry. Okay, so we've got the basic structure down. Now let's get into the nitty-gritty. We're going to put stocks and ETFs head-to-head on three crucial battlegrounds: risk, cost, and taxes. This is where the real trade-offs start to become crystal clear. First up, let's talk risk. The risk you take with a single stock is what we call idiosyncratic. It's totally unique to that one company. If that company has a terrible quarter or a scandal, you feel that pain directly and immediately. But with an ETF, that kind of company-specific risk gets massively diluted. If one company in the basket goes down, its failure is cushioned by all the others. The main risk you're left with is just the overall market going up or down. All right, next up, cost. Now this one's a little tricky. These days, with zero commission trading, it often costs you nothing to buy either a stock or an ETF. But here's the hidden detail: the annual fee. A stock costs nothing to hold. An ETF, though, has something called an expense ratio. It's a tiny percentage you pay each year for the fund's management. It might seem small, but for a long-term investor, that tiny, persistent fee is actually the most critical cost to keep your eye on. And finally, we have taxes. Again, a story of trade-offs. Stocks give you that absolute control we talked about. You and only you decide when to sell and create a taxable event. But ETFs have this incredible, almost secret weapon, a structural advantage where they can trade stocks inside the fund without generating capital gains for you, the investor. It's a hugely powerful built-in benefit that means the fund rarely passes a tax bill onto you, letting your money grow and compound for much, much longer. So, we've looked at the mechanics, right? Stocks give you control, ETFs give you built-in diversification and tax advantages. But the real question is, which strategy actually wins out in the real world? It's time to stop talking about theory and look at the cold, hard data. I mean, this is the whole ballgame, isn't it? Can a smart person, or even a team of highly paid professionals, consistently pick winning stocks that do better than a simple, cheap, boring market index? The answer might just blow you away. Just look at this. This data tracks the performance of professional money managers, the folks who do this for a living. And over a 3-year stretch, only about 15% of them actually manage to beat their market benchmark. Let that sink in. That means 85% of the pros are failing to do the one thing they are paid to do: beat the average. And it gets worse. If you stretch that timeline out to a full decade, the number of pros who underperform the market jumps to around 90%. 90! The data is just overwhelmingly clear. Trying to consistently beat the market is an incredibly difficult, low-probability game, even for the people who are supposed to be the best at it. So where does that leave us? Should you just give up on ever picking a stock again? Well, not necessarily. This leads us to a really powerful, really elegant strategy that smart investors use. It's not about choosing stocks or ETFs. It's about using them both in a very deliberate, structured way. Welcome to the core satellite approach. The idea is brilliant in its simplicity. The vast majority of your money, your core, is built on a rock-solid foundation of low-cost, diversified ETFs. That part is designed to just capture the reliable returns of the market. And then you use a much smaller, separate satellite portion for your high-conviction, targeted bets on individual stocks. Here's how you do it. First things first, you build your foundation. You put somewhere between 70 and 90% of your portfolio into that boring, dependable market tracking core. Then, and only after that is secure, do you take your calculated shots with the leftover 10 to 30% in your satellite. This lets you scratch that stock picking itch, but it contains all that high risk to a small, manageable part of your portfolio. So this all leads us to a clear, actionable game plan. You anchor the vast majority of your wealth in the statistical reliability of broad market ETFs. Then you use a small, strictly budgeted satellite to take your shots on potential big winners. This really does give you the best of both worlds. You get the market's steady growth, plus the chance for that exciting outperformance, all while protecting your financial future from emotional, high-stakes gambles. And that brings us to the final, and maybe most important question. When you look at your own investments, I want you to ask yourself, is my approach built on a sound, data-driven strategy like this? Or am I just rolling the dice and hoping to get lucky? Honestly, the answer to that question could make all the difference.